Good day, everyone, and welcome to another episode of Fryer Financial's Financial Forum. Marcus Fryer here again with Jeffrey Campbell, and we are in week 2 of our presentation on tax-free strategy. So in the Wealth Wisdom Corner, today we're going to be talking about the traditional IRAs and that bucket of money and why you need it, how you use it a little bit. And we'll focus on both higher income earners as well as kind of those starting out at the lower income thresholds and in that strategy. But of course, as always, we'll begin with our markets in motion segment. So, Jeffrey, if you can take it away and tell us a little bit about what was going on in the markets last week.
Yes, sir. Markets were a little bit choppy this week, but the story did end on a high note. So we opened strong on Monday, and we sold off midweek as investors rotated out of tech and then snapped back on Friday with a broad buy the dip rally. So the Dow punched through 50,000 for the first time. The S&P reclaimed some of their lost ground, and the consumer sentiment hit a 6-month high. Earnings also continue to come in better than expected, with nearly 80% of companies beating estimates. Overall, a pretty volatile week that we will take a deeper dive in and examine. Starting with starting with some of the gains in the market. The markets were mixed today, so we had some sharp rotations with strong gains Monday and Friday, kind of offsetting the midweek selling pressure as investors absorbed earnings from more than 100 S&P 500 companies.
Yeah, it was a lot of reporting last week. I think we hit some of the highlights, but there was a ton of earnings reportings last week. Um,
hmm
as Jeffrey is mentioning, the S&P technically was actually barely down. NASDAQ was actually down. Dow Jones was the one that they were talking about that was up. And it was the first time it had broken through 50,000 points. So that was impressive, of course. And like Jeffrey mentioned earlier, so we could see that the investors were buying the dip a little bit and what was going on there. So kind of different. Let's just take them through each day of the week and what a roller coaster it truly was.
Yep, yep. Let's start with Monday. Stocks surged right out the gate on Monday as investors positioned for a heavy week of Q4 earnings, kind of touching on what Marcus was just talking about. And then Tuesday, the sentiment flipped as investors rotated out of tech and into cyclicals tied to economic improvement. Wednesday, we saw a little bit of softer private sector job growth added to the caution that we've been seeing. And then Thursday, saw the S&P briefly dip negative year to date. And then Friday reversed everything. So Friday we had broad buying that lifted all major indices, with the Dow closing above 50,000 for the first time and the S&P up 2%. So then all on top of that, the University of Michigan's Consumer Sentiment Index hit a 6-month high, kind of helping fuel the rebound that we've been seeing. So like Marcus said, it was a roller coaster all throughout the week, kind of ending with a chaotic Friday. So
Yeah, that kind of highlights how sometimes it's not really the performance, because as we'll mention in a minute how everybody performed, but a lot of times it's how investors are feeling, and with that investor sentiment and consumer sentiment going up, and we know the consumer runs the economy, that really help the markets rebound because we get into looking about earnings season. So as we're saying about it says almost 290 companies have reported so far for their Q1 or their earnings estimates, and 70% of the S&P 500's market cap has now reported, and almost 80% have beat expectations, and only 17% of those reporting have missed. So that's giving us some clues that the markets are actually performing, companies are performing a little bit better than they even thought they were going to do. So that's definitely optimistic. All right, so let's move into part two. As always, our second segment, Finance in Focus, where we'll kind of drill down a little bit deeper on some of these concepts. So, Jeff, take Finance in Focus away.
yep. So this week's economic picture was pretty mixed. The job growth slowed sharply in the ADP report. Layoffs spiked to their highest January level since 2009. And the official employment report was delayed by the government shutdown, of course. And investors are trying to square that with a Fed that still sees solid economic activity and inflation running a bit warm. Bitcoin slide to a 15-month low, underscored how fragile risk appetite can be. All eyes now turn to CPI and the delayed jobs data.
Mm, yeah, exactly. Let's see. So, with respect to those jobs, ADP reported only 22,000 private sector jobs were added. So that's about half of what they expected. And then Challenger reported 108,000 layoffs, and that is the highest January total since 2009. So that's probably giving the feds a lot of pause in what they're seeing is that concerns in that labor market. That's
Exactly.
that's definitely concerning. And then
Hmm.
inflation is still up a little bit. So what do we got on this week's economic calendar? Just a few things, big things Wednesday, Thursday, and Friday. Who we got reporting?
Yep. So Wednesday we got the employment report, and then the federal budget, which will both be two kind of touching on what markets are seeing about how the Fed is viewing some of this stuff. So some interesting stuff there. And then Thursday we got jobless claims, home sales from January, and then Moran speaks. And then Friday we got the CPI, as I mentioned a little bit earlier. So, yep, that's what we got looking at the rest of the week. And then just kind of want to touch on crypto before we
Sure.
finish here.
Yeah.
Like I was saying earlier, Bitcoin did hit that 15-month low, kind of talking about that risk appetite, and that low was $60,000 and $33, and that's his biggest daily drop since 2022 before rebounding.
Yeah, and I think we talked about that a little bit last week, and that those people were kind of fleeing to the metals, gold and silver.
Exactly. Yeah,
So
physical assets.
yeah, yeah. So you're starting to see that thought process come into play. As no, I can't really touch this Bitcoin. It's not physical.
Exactly.
Yes.
And that's always been a concern behind it, where that, like I said, that risk appetite is a little bit higher when it comes to the crypto.
Yeah, yeah, absolutely,
Hmm.
absolutely. And that goes back to goals-based planning that we always preach. You know,
Yep.
hit your goal and get out. Don't
Yep.
be happy. So,
Yep.
all right, all right. So as we continue on into the Wealth Wisdom Workshop, as I was saying, this week we're talking about another bucket that we're going to need for this tax-free retirement strategy, and that is going to be the traditional pre-tax bucket, whether it be through your 401k or through a traditional IRA. So Jeff's going to take it away and explain just that the traditional bucket, both sides of that, and where we see it being used in today's for people, managing taxes, of course. So, Jeff, you can define that for us and what that looks like.
Yeah, so like Mark said last week, we touched on Roth. So we saw what kind of strategies around investing your after-tax dollars. But a traditional IRA is used for pre-tax dollars, kind of similar to your 401k. In that sense, where the money you work for before taxes come out of it is contributed into that bucket, and that comes with a lot of different strategies. A lot of time that's used for our higher income folks because the income taxes that pay on that money right now are going to be higher than what they would pay in retirement. So we want to delay that tax hit until down the line. So that's probably the biggest way we see that the traditional bucket used compared to the Roth. But there's still ways to use it no matter whatever your income is, depending on what the strategy is. And I'll let Marcus touch a little bit more on that.
Yeah, absolutely. So, a lot of times when we're first, graduating college, of course, we're in a little bit lower tax bracket. So you'll kind of gravitate towards the Roth side, going, "Hey, I'm in a low tax bracket." Start to fill up the Roth side of this bucket. And then eventually, as incomes rise, you start to go, "Oh gosh, now I'm in a 22, 24, 32% bracket. And I only expect 20% in retirement. So let's kind of switch gears here, or at least do a little bit of both. But where it becomes important is just keep in mind that within our tax returns, and this will be part of the strategy, is the IRS gives us a free bucket of money each year. It's called the standard deduction. And so what we'll end up doing is filling up that standard deduction with this pre-tax money. So that way we actually keep it from being taxed down the road. Just imagine you're taking that deduction today, and then in our strategy down the road, because we're only going to take out money up to that standard deduction, we're going to keep that money pre-tax and free.
Yep.
That's part of that whole tax strategy that we'll get to. So we've covered two of the things, the Roth and the traditional. And what we have left will be, and we'll talk next week about the taxable brokerage account. And then we'll talk about the fourth week, the health savings account and how that
Mm.
fits into the strategy. And then week 5, we'll put it all together with the step by step of what you're doing, how you're filling up each of these buckets, and exactly how you would pull money out to create a tax free retirement. So, as always, it's been a good week. Markets are looking good, things are going well. again, like the channel, subscribe to the channel, and please share with people. We've got to get information out. Jeffrey and I are talking every day with people, and they just don't know. You know,
Hmm.
this is really an educational channel at this point, and we're just trying to get content out. So until next week, Chris Fryer here, Jeffrey Campbell there, and again next week. Thank you all for joining us, and we'll talk to you again. Have a great week, everyone. Take care.